A public or large private company performs cash reconciliation to understand how cash moves through the business and ensure reported balances accurately reflect operational activity. By comparing recorded cash inflows and outflows to bank results, the company gains insight into collection patterns, payment timing, and seasonal fluctuations. This visibility helps management identify trends in working capital, assess liquidity needs, and improve the accuracy of short-term cash forecasting. Regular reconciliation ensures that cash data used for forecasting and planning is reliable, allowing the company to make better decisions about funding, investment timing, and overall cash management efficiency. For large companies managing multiple banking relationships, reconciling and interpreting cash activity is often complex and time-consuming. Each bank provides transaction data in different file formats, with inconsistent structures and limited categorization of cash activities. Even with standards such as BAI, implementation varies by bank, and the information still lacks sufficient granularity to clearly distinguish collections, disbursements, fees, or internal transfers. In addition, interbank movements within the same company often blur the lines between true cash inflows and outflows, especially when accounts are used in a commingled manner for both operating and funding purposes. An automated tool that can ingest diverse bank reports, normalize the data, identify and classify transaction types, and produce a consolidated summary report would be extremely valuable. It would eliminate repetitive manual work, improve visibility into actual cash movements, and create a reliable foundation for daily cash position reporting and forecasting. By systematically mapping patterns in transaction behavior, such a tool enables finance teams to better understand liquidity trends, reduce reconciliation delays, and make timely cash management decisions. Ultimately, automation turns fragmented bank data into structured insight, improving both efficiency and the quality of financial analysis. Treasury management systems, TMS, are designed to centralize cash visibility, offering automated bank data imports and standardized reporting. Most modern TMS platforms can connect to banks via APIs or file uploads, interpret transaction codes, and produce summary dashboards. However, in practice, these tools still require significant human intervention when dealing with complex or non-standard bank data. Each bank's file structure, naming convention, and transaction classification differ, and even small inconsistencies can prevent full automation. While some TMS vendors claim to leverage AI to interpret or categorize transactions, these models often operate as black boxes, offering limited transparency into how classifications are made. For organizations that value auditability, customization, and control over their data logic, relying solely on a TMS can feel restrictive. An in-house automation tool can complement or even outperform a TMS by providing tailored data parsing, rule-based classification, and transparent logic that can be continuously refined by internal teams. This hybrid approach allows treasury and finance professionals to maintain both efficiency and interpretability, gaining automation without sacrificing flexibility or trust in the data that underpins daily cash and liquidity decisions. Today, I am introducing an Excel-based tool automatically analyzes and summarizes bank reports from multiple banks in a fully customizable and transparent way. Built on the new native Python integration in Office 365, it combines Excel's familiar interface with Python's powerful data processing, allowing users to classify cash movements, aggregate results, and generate clear summary reports without leaving Excel or installing anything extra. In order to make the point that with AI, creating automation tool is far easier than most expect, even for non-programmers, I used AI to help create and adjust Python code. Tailored to the company's specific need, this tool reduces a manual 2-hour reconciliation task to under 30 minutes, improving both accuracy and speed in treasury and cash management. In my example, the company has 4 banks, W, R, A, and S. Each bank has a few accounts. Bank A has a ZBA structure to separate collection and disbursement. Bank W has one business unit that employs a ZBA structure for collection, and the other accounts' activities are commingled. Bank R and S don't have structure. In addition, Bank S has one USD account and one CAD account. Their reports' format and quality vary greatly, as one can imagine. We need analyze their report one by one to find rules to categorize for each individual bank. Bank W's report has BAI, and its use of BAI is very consistent. I used a whitelist approach. So long as BAI is either 145 or 195, the credit is considered as collection from customers. And so long as BAI is any of 455, 475, 495, and 506, the debit is considered disbursement to third party. Bank R's report doesn't have BAI, but its use of data field transaction description is also very consistent. So long as the transaction description is any of pre-authorized ACH credit, check deposit package, and incoming money transfer, it is collection. And so long as the transaction description is any of check paid, pre-authorized HH debit, and outgoing money transfer, it is disbursement. Bank's report provides a data field transaction code. I used a blacklist approach. So long as the transaction code is neither 840 nor 845 and it is credit, it is collection. And so long as the transaction code is none of 915, 980, 981, 986, and it is debit, it is disbursement. Bank A's report has a data field transaction that is almost as good as Bank R's transaction description, except when it is check paid, there is a check number in it. We will need transform it. After this transaction is transformed to transaction 2, we can write the rules. So long as the transaction 2 is any of individual international money transfer credit, pre-authorized ACH credit, other deposit 0, lockbox deposit 18229, and incoming money transfer, it is collection. And so long as the transaction 2 is any of check paid, individual international money transfer debit, pre-authorized ACH debit, and outgoing money transfer, it is disbursement. Lastly, I used a quick trick to solve the interbank transfer issue. When I create transfer, I only transfer money with whole multiple of 10,000. I build a formula using if the amount can be divided by 10,000 by whole as the criteria to label it as interbank transfer. Some bank charges $25 for wire fee, so I made the adjustment in the formula to account for this situation. You are free to create your own way to make it work. And don't forget to do a sanitary check. Don't rely blindly on these rules. I didn't write any Python code myself. You just need to ask AI to code for you. Put the code into Excel and start to adjust or link to a cell so you can adjust, add, or delete the criteria as you wish. Python coding is not difficult at all if you can explain your demand in logical way. Finally, add a summary table to make it presentation ready. I would recommend using a format that can be directly copied into your cash forecast model. I'm going to introduce how to use AI and Python to forecast cash in the next vlog.